Disclaimer.
The president announces a deal that promises to flood our markets with cheap oil, stabilize gas prices at the pump, and restore America's energy dominance. Wall Street cheers. Political allies celebrate. The media declares victory. But behind closed doors, the biggest names in American oil, Exxon, Chevron, ConocoPhillips, aren't celebrating at all. They're walking away. And when you see the numbers they're looking at, you'll understand why this isn't an opportunity. It's a trap disguised as one. Welcome to the Venezuela oil situation, where political promises just collided with financial reality in the most spectacular way possible. And here's what should grab your attention. We're not talking about a small miscalculation or an optimistic forecast that might fall short. We're talking about a $183 billion black hole that could become the largest energy sector loss in American history, with you and I potentially covering the shortfall when the math finally catches up to the rhetoric. Let me walk you through exactly how this trap works, because once you see the mechanism, you'll never look at energy announcements the same way again. Start with the promise. Venezuela sits on the world's largest proven oil reserves. Bigger than Saudi Arabia, bigger than Russia, bigger than anything in North America. We're talking about 304 billion barrels of proven reserves just sitting there, waiting to be tapped. For years, sanctions kept that oil locked away while our gas prices climbed and Americans paid more at the pump with every fill-up. Now, with regime change on the horizon and diplomatic relations warming, there's talk of unleashing Venezuelan production to benefit American consumers and companies. Lower prices for working families, more supply security for our economy, less dependence on Middle Eastern oil. It sounds perfect. It sounds like exactly what our economy needs right now. But here's where the story takes a sharp turn into mathematics that don't work. Rystad Energy, one of the most respected oil analytics firms in the world, just published their calculation. According to their data, reported by the American Journal of Transportation, restoring Venezuela's oil production to just 3 million barrels per day by 2040 requires $183 billion in investment. Let that sink in for a moment. Not 3 million barrels per day next year or even in 5 years. That's the target for 15 years from now. We're not even talking about matching their peak production from the 1990s when they pumped 3.5 million barrels daily, and Venezuela was an oil powerhouse. We're talking about spending nearly $200 billion just to reach a fraction of their former capacity more than a decade and a half into the future. Now, you might be thinking, okay, $183 billion is a lot, but American oil companies spend billions all the time developing new fields in the Gulf of Mexico and Texas shale formations and offshore projects around the world. What makes Venezuela different? Here's what makes it different. The infrastructure problem is unlike anything our companies have dealt with in modern history. And the economics are worse than any project they've ever walked away from. Venezuela's national oil company, PDVSA, hasn't meaningfully updated its infrastructure in 50 years. Think about that for a moment. 50 years of deferred maintenance, outdated equipment, and deteriorating systems while the rest of the world's oil industry modernized, automated, and optimized. When American companies were implementing advanced drilling techniques and real-time monitoring systems, Venezuela's infrastructure was slowly collapsing under corruption, mismanagement, and lack of investment. CNN's investigation revealed that Venezuela's pipelines are prone to daily spills. Not occasional accidents that make headlines, but daily events where crude oil leaks into communities and ecosystems because the pipes are literally falling apart beneath the ground. This isn't a situation where you can drill a few new wells and start pumping profitable barrels. This is a complete rebuild from the ground up, where you're essentially constructing a modern oil industry inside the shell of a failed one, while that shell continues to deteriorate around you. Every piece of equipment is outdated. Every pipeline needs replacement. Every refinery requires massive overhauls. Every storage facility poses environmental and safety risks. You're not investing in production. You're investing in preventing catastrophe first. Then maybe, eventually, you can start thinking about profitable production. And here's where the timeline becomes absolutely critical for understanding why major American companies are refusing to commit, despite political pressure and public promises. According to industry analysis from the American Journal of Transportation, between $30 and $35 billion must be committed in the first 2 years alone, not spread out over a decade of gradual development, not carefully phased in as production ramps up and revenues start flowing. $30 to $35 billion needs to flow into Venezuela in 2026 and 2027 to even begin stabilizing existing production and preventing further collapse of the infrastructure that's still barely functioning. That's an immediate funding crisis starting next year, and right now, there are zero willing investors stepping forward with that kind of capital. Exxon hasn't made a commitment. Chevron hasn't made a commitment. ConocoPhillips hasn't made a commitment. These aren't small independent operators without resources. These are the titans of American energy with hundreds of billions in market capitalization and decades of international experience. The companies with the technical expertise and financial resources to actually execute this rebuild are looking at the same numbers you're about to see, and they're quietly, methodically walking away from the table. But the investment timeline is only the first layer of this trap. Let's talk about what happens even if someone somehow finds that $30 billion to invest in the first 2 years. What do they get for their money? What's the return on that massive upfront capital commitment? The global oil market right now faces a 2 million barrel per day oversupply according to market analysis. That means the world is already producing 2 million barrels more than it consumes every single day. Prices reflect this reality. We're sitting around $60 per barrel right now, and that's with OPEC trying desperately to support prices through coordinated production cuts among member nations. Saudi Arabia has been cutting output. Russia has been cutting output. The whole point of these cuts is to keep prices from falling even further in an oversupplied market. Now, according to NPR's analysis of Venezuelan production economics, Venezuela's break-even cost, the price at which Venezuelan oil becomes profitable to produce after accounting for all the infrastructure rebuilding, operational costs, and transportation, sits at $80 per barrel. Read that again because this is where the trap snaps shut. The current market price is $60. The price needed to make money on new Venezuelan production is $80. This means that from day one, every single dollar invested in rebuilding Venezuelan oil infrastructure is losing money. Not eventually. Not if market conditions worsen. Not if something goes wrong with the project. Right now, today, with current prices and current costs, the investment loses money before a single new barrel reaches market. You're not betting on future profitability or banking on oil prices rising. You're guaranteeing present-day losses and hoping something dramatic changes in the global market to save you from financial disaster. Think about this from the perspective of a Chevron executive walking into a quarterly earnings call and trying to explain this investment to shareholders who expect returns on their capital. We'd like to commit $35 billion over the next 2 years to develop oil production in a country with a history of expropriating foreign assets, where the infrastructure hasn't been updated in half a century, where every barrel we eventually produce will lose us $20 at current market prices, where we won't see positive cash flow for at least a decade, and where political instability could derail the entire project at any moment. Any questions? The questions would be deafening, and the shareholder lawsuits would be inevitable before the first billion left the company's accounts. This isn't even a high-risk, high-reward scenario that aggressive investors might consider. This is a guaranteed loss scenario dressed up in the language of opportunity, energy independence, and geopolitical strategy. But here's what makes the situation truly dangerous for American taxpayers and why you should care even if you don't own oil stocks. Political promises have been made. Expectations have been set. The narrative of cheap Venezuelan oil saving Americans, money at the pump has already been sold to millions of voters who are struggling with inflation and hoping for relief. What happens when private companies refuse to make an economically irrational investment? What happens when Exxon's board says no, when Chevron's shareholders revolt, when ConocoPhillips calculates the losses and walks away? What happens when the math doesn't work, but the political commitment to see it be walked back without massive embarrassment? That's when this becomes our problem. That's when government intervention gets floated as the solution to make the impossible work. That's when we hear about strategic initiatives, national interest investments, and public-private partnerships. All language that translates into taxpayer money flowing into that $183 billion black hole, because the alternative is admitting the whole premise was flawed from the start. We're looking at a financial trap with a political trigger, and the countdown has already begun. The companies who understand oil economics are already backing away. The question is whether our government will recognize the trap before we're too committed to escape. Now let's talk about what the people who actually understand the oil business are saying when they think no one's paying attention. Because while politicians make promises and headlines celebrate potential deals, the experts who would need to execute this rebuilding project are delivering a very different message, and their silence speaks even louder than their words. Hugh Daigle is a petroleum engineering professor at the University of Texas, one of the premier institutions for oil and gas education in our country. This isn't some critic with an agenda or a competitor trying to undermine the opportunity. This is someone who trains the engineers that work for Exxon, Chevron, and every other major oil company. His students go on to design drilling programs, evaluate reservoirs, and make the technical decisions that determine whether billion-dollar projects succeed or fail. When Al Jazeera asked him about the business case for American companies investing in Venezuelan oil, his response was devastatingly clear. I do not see a compelling business case for any U.S.-based company to invest billions of dollars over years to decades to try to turn a profit in Venezuelan oil. Read that statement carefully. He's not saying it's risky, but potentially rewarding. He's not saying it's challenging but achievable with the right approach. He's saying there is no compelling business case. meaning when you run the numbers, when you factor in the costs and the timeline and the risks and the market conditions, the math simply doesn't work for any rational investor operating in the real world. And remember, this assessment comes from someone who spends his career analyzing oil projects around the world, publishing peer-reviewed research on petroleum economics, and teaching future petroleum engineers how to evaluate opportunities with clear-eyed realism. But maybe that's just one academic's opinion, right? Maybe he's being overly conservative or doesn't understand the political dimensions that make this different. Let's look at what the companies themselves are saying, or more accurately, what they're carefully not saying. ConocoPhillips, one of the largest American oil companies with a market capitalization over $140 billion, and a major player with decades of international experience across 6 continents, released an official statement through Supply Chain Brain when asked about their plans for Venezuelan investment. Here's the exact corporate language they used. It is premature to speculate on any future business activities. In the world of corporate communications, where every word gets vetted by legal teams and investor relations departments, that's not cautious optimism. That's a polite way of saying absolutely not, but we can't say that directly because of political sensitivities and diplomatic complications. Think about how companies typically respond when they're genuinely interested in a major investment opportunity. They talk about conducting comprehensive assessments. They mention exploring possibilities and engaging with stakeholders. They say they're evaluating the situation closely and will update shareholders as circumstances develop. They project cautious optimism while managing expectations, but premature to speculate on any future business activities is corporate speak for, we've already run the numbers. We know this doesn't work. We're not going anywhere near it. But we need diplomatic language because there's political pressure involved and we can't afford to antagonize government officials. The same pattern appears across every major American oil company. Exxon hasn't announced Venezuelan plans. Chevron hasn't committed capital. Independent producers aren't lining up with proposals. The silence is universal among companies that actually have the resources and expertise to execute these projects. And that universal silence from every credible player tells you more than any official statement ever could. And here's where it gets even more revealing. A detail that turns skepticism into absolute certainty that this won't work. These companies aren't just skeptical about future investments based on current economics. They're still fighting to recover money from past investments that Venezuela took from them, creating a legal mess that remains unresolved years later. ConocoPhillips currently holds $10 billion in outstanding claims from Venezuela's previous nationalizations under Hugo Chavez. That's $10 billion that Venezuela seized from them when the government decided to simply take control of foreign-owned oil assets, compensating the companies at a fraction of their true value or not compensating them at all. According to CNBC's reporting, Exxon has $2 billion in unresolved arbitration cases still working through international courts, grinding through legal processes that have dragged on for over a decade with no resolution in sight. These aren't ancient history from some distant era. These are ongoing legal battles where American companies are trying to recover money that Venezuela took from them the last time they made the mistake of believing political promises about investment security and property rights. Now, put yourself in the position of a Chevron board member sitting in a Houston conference room trying to decide whether to approve tens of billions in new Venezuelan investments. You're being asked to commit massive capital to a country that still hasn't paid back the money it seized from your competitors and industry partners the last time they invested there. You're being told that this time is different, and that the new government will respect contracts and protect foreign investment. But the old government made those exact same promises before the nationalizations. They signed agreements, they provided assurances, they courted foreign investment aggressively, and then they took everything anyway when political winds shifted and populist pressure mounted. Would you vote yes on that investment knowing this history? Would you stand in front of your shareholders at the annual meeting and explain that despite $12 billion in unresolved theft from other American oil companies, theft that remains unpaid to this very day, you're confident this time will be different because of assurances from a government that hasn't even fully formed yet? The legal chaos and asset seizure risks make this investment radioactive for any executive who values their career and any board that fears shareholder lawsuits and activist investors calling for their removal. But let's set aside the historical problems and the expert skepticism for a moment. Let's look at what independent analysts are saying about the pure logistics of rebuilding Venezuelan oil production. Because even if you could somehow solve the trust issues and the legal problems and the political risks, the operational reality is staggering in ways that make profitability virtually impossible. According to analysis reported by CBS News, independent energy experts estimate the rebuild will take a minimum of 10 years and cost up to $100 billion. That's a decade of continuous investment, technical work, and operational improvements before you even approach the production levels that might generate positive returns on the massive capital deployed. But here's the detail that makes this timeline truly impossible to sustain. Oil industry executives told CNBC that Venezuela needs $10 billion annually just to stabilize existing production, meaning just to prevent further collapse of the infrastructure that's barely functioning today and keep current output from declining even more. Think about what that means in practical terms. Before you can even start growing production to eventually reach profitability sometime in the distant future, you need to spend $10 billion every single year for the foreseeable future, just to keep the current broken system from deteriorating further and producing even less than it does now. That's $10 billion annually that generates zero growth, zero new production, zero progress toward the 3 million barrel per day goal that justifies the entire investment thesis. It's pure maintenance spending on infrastructure that's already failed, and you have to commit to that spending knowing that if you stop for even 1 year, everything collapses even faster and your previous investments become worthless. And here's the context that makes this entire discussion almost absurd when you step back and look at the big picture. Venezuela currently produces only 900,000 barrels per day. To put that in perspective, global oil production runs around 100 million barrels per day. Venezuela right now represents barely 1% of global supply, less than the daily production fluctuations we see from routine market movements, weather events, or minor OPEC adjustments. We're talking about spending up to $100 billion over a decade to rebuild capacity in a country that currently contributes 1% of global supply, requires $10 billion annually just to maintain that 1%, and has a documented history of seizing foreign assets when political circumstances change. The risk-reward equation is not just unfavorable. It's catastrophically imbalanced in ways that would get any executive fired for even proposing it seriously to their board of directors. But there's another layer to this proof that the trap is real, and it comes from looking at what companies are actually doing with their investment dollars right now while they publicly stay silent about Venezuela. American oil companies are actively investing billions in projects around the world. Deep water drilling in the Gulf of Mexico, shale expansion in the Permian Basin of Texas, offshore developments in Guyana and Brazil. These are projects with clear economics, stable legal frameworks, proven returns, and governments that respect contracts. The money is there. The investment appetite exists. The technical capability is ready and waiting to be deployed. What's not there is any willingness to commit that money to Venezuela, despite political pressure and despite public promises about energy independence and bringing cheaper oil to American consumers. When companies consistently choose to invest everywhere else except the opportunity that's being publicly promoted as a game changer for American energy security, that tells you everything you need to know about what their internal analysis really shows. The companies that would need to make this work have effectively said no. The experts who understand the industry have said the business case doesn't exist. The independent analysts have calculated timelines and costs that make profitability nearly impossible. And the historical evidence shows that even if you somehow overcome all those obstacles, Venezuela has a proven track record of taking your assets anyway when it becomes politically convenient. This isn't skepticism or pessimism. This is a wall of evidence from every direction showing that the $183 billion investment isn't an opportunity at all. It's a carefully disguised trap that gets more obvious the closer you look at the details, and we're walking straight toward it. Now let's run the actual numbers with specific dates and see exactly when this trap snaps shut. Because the beautiful thing about mathematics is that it doesn't care about political promises or diplomatic optimism. It just reveals what's actually going to happen when reality meets projections. And what these calculations show is that Venezuela becomes a financial black hole at every single milestone along the timeline, with losses compounding faster than anyone wants to publicly acknowledge. Start with December 2026, less than 12 months from now. According to analysis from the National, even with full sanctions relief and immediate foreign investment starting to flow, Venezuelan production could reach only 1.2 million barrels per day by the end of next year. That's the optimistic scenario where everything goes right. Sanctions lift immediately, companies somehow commit capital, despite all the evidence we just discussed. The infrastructure doesn't collapse further during the rebuilding process, and technical teams successfully begin stabilizing operations without major incidents or delays. At current oil prices of roughly $60 per barrel, producing 1.2 million barrels daily generates approximately $26 billion in annual revenue for Venezuela. That sounds like a substantial amount of money, enough to fund significant operations and start paying back investors. Until you remember the trap we discussed earlier. According to the American Journal of Transportation, restoring production requires $30 to $35 billion in upfront investment by 2028 just to maintain the momentum needed to prevent further infrastructure collapse and enable growth toward higher production targets. Here's where the cash flow trap becomes inescapable, creating a mathematical impossibility that no amount of optimism can solve. Venezuela generates $26 billion annually from oil at 1.2 million barrels per day, but they need $30 to $35 billion invested upfront by 2028 just to maintain momentum toward higher production targets. The math does not work even if you give Venezuela every single dollar of their oil revenue. They literally cannot generate enough cash from production to pay back investors, while simultaneously funding the continued infrastructure, rebuilding that's absolutely essential to prevent collapse. And remember, this $26 billion isn't profit sitting in an account ready to be distributed to investors. This is the government's total revenue from oil exports before any costs are deducted. Venezuela still has to run a country with this money. They need to pay government employees. They need to fund social programs that keep the population from revolting. They need to maintain basic services like electricity and water systems. They need to import food and medicine and consumer goods. By the time you account for the basic costs of operating a nation of 28 million people, there's virtually nothing left to pay back foreign investors or fund continued infrastructure improvements. Any private investor looking at this timeline immediately sees the problem that should be disqualifying from day one. You are committing $35 billion by 2028 to a country that will generate $26 billion annually from oil and needs every dollar of that revenue just to function as a nation and avoid social collapse. Where does your return come from? When do you start seeing payback on your massive investment? The answer is never, unless oil prices somehow surge above $80 per barrel and stay there consistently for decades. A scenario that becomes less likely with every barrel of new Venezuelan supply that enters an already oversupplied global market that doesn't need more oil. But let's be generous and assume someone finds a way to push past this initial cash flow trap. Let's say that by some miracle, massive investment continues flowing despite the negative economics we just walked through. Maybe governments provide guarantees. Maybe development banks step in with subsidized financing. Maybe political pressure forces some level of participation. What happens by 2030 when production is supposed to reach more substantial levels? According to the National's analysis of industry projections, reaching 2 million barrels per day by 2030 requires $110 billion in upstream investment and what analysts delicately call deep reform of Venezuela is entire oil sector, fundamental restructuring of PDVSA, elimination of corruption that's endemic to the system, establishment of transparent accounting and operations, and creation of legal frameworks that protect foreign investment. These same analysts who developed these projections also say such reform is unlikely to actually occur, given the political and institutional resistance embedded in Venezuela's power structures. Think about what this means. We're betting $110 billion on reforms that the experts who created the projections believe probably won't happen. We're assuming that a country with decades of corruption, mismanagement, and authoritarian governance will suddenly transform into a transparent, well-regulated, investor-friendly environment, all while dealing with the social and political turmoil of regime change and economic rebuilding. The projection requires conditions that contradict everything we know about how nations actually function under stress. But here's where the global context becomes absolutely critical for understanding why this investment gets worse, not better, as production increases. The International Energy Agency, the gold standard for global energy forecasting, projects that worldwide oil demand will plateau around 105.5 million barrels per day by 2030. Not continue growing aggressively like it did for the past 50 years. Not expand to accommodate new supply. Plateau. The era of endlessly increasing oil consumption is ending as electric vehicles proliferate worldwide. Efficiency standards tighten, renewable energy scales up, and the energy transition accelerates across developed economies. Now think carefully about what happens when you add 2 million barrels per day of new Venezuelan supply into a market that's not growing. Those 2 million barrels don't fill new demand that didn't exist yesterday. They displace existing supply from somewhere else in a zero-sum game. Saudi Arabia has to cut production to accommodate Venezuelan barrels and maintain price stability. American shale producers lose market share and see revenues decline. Russian exports get squeezed. Every new Venezuelan barrel pushes prices down because it's adding supply to a stagnant market that doesn't need more oil and has no room to absorb additional production without price collapse. This is the fundamental flaw in the entire Venezuela investment strategy that no one wants to acknowledge publicly because it undermines the entire premise. We're spending over $100 billion to add supply to a market that doesn't want more supply, which inevitably crashes the price through basic supply and demand economics, which makes the investment lose even more money than it was already losing at current prices. It's not just a bad investment based on today's numbers. It's an investment that actively gets worse the more successful it becomes at actually producing oil. And now we arrive at the final calculation that exposes just how catastrophic this becomes, turning a bad situation into an impossible one. Goldman Sachs, one of the most sophisticated commodities research teams in the world, with billions of dollars riding on the accuracy of their oil market analysis, ran the numbers on what happens to global oil prices if Venezuela successfully reaches 2 million barrels per day. Their analysis, reported by CNBC Africa, estimates a $4 per barrel price decline from current levels. That might not sound particularly dramatic, just a modest decrease in a commodity that fluctuates regularly, until you do the math on what it means for investment returns in Venezuela specifically. Current oil prices sit around $60 per barrel. A $4 decline pushes prices to $56 per barrel. Now remember Venezuela's break-even cost that we discussed at the beginning? $80 per barrel. So successful Venezuelan production that reaches the 2 million barrel per day target would be operating $24 below break-even, meaning every single barrel produced loses 24, compared to what it costs to extract, process, transport, and sell. The more oil Venezuela successfully produces, the more money the entire operation loses, and there's no volume of production that makes this equation work. This is the final trap clicking shut with mathematical precision. The $183 billion investment doesn't just lose money because of temporarily unfavorable market conditions that might improve someday if we're patient. It loses money because its own success crashes the market further, guaranteeing that profitability becomes impossible regardless of how efficiently the operation runs, how much technical expertise gets applied, or how effectively costs get controlled. You're not betting on future conditions improving to save your investment. You're actively creating the conditions that make your investment worthless through the very act of successfully increasing production. Let me put this in perspective with a concrete example. Imagine you're a pension fund manager in Texas responsible for the retirement savings of 500,000 teachers, firefighters, and government employees. Someone proposes that you invest $10 billion of your fund's money into Venezuelan oil rebuilding. You run the numbers and see that success means producing oil at 56 per barrel that costs 80 per barrel to extract, a guaranteed loss of $24 on every barrel. Would you approve that investment? Could you explain to retired teachers why their pension lost billions on a project that was mathematically guaranteed to fail from day one? And here's what happens when this mathematical reality becomes undeniable to everyone involved, probably sometime between 2027 and 2029, when the losses start mounting, and investors who committed capital start demanding explanations at shareholder meetings. Private companies will walk away. They'll cite changed market conditions, unexpected technical challenges, or regulatory concerns as the official reason for their exit. But the real reason will be the same math we just walked through, an investment that loses money at every milestone and gets worse with every barrel produced. But political promises have been made to the American people. Voters have been told that Venezuelan oil will lower their gas prices and strengthen American energy security. Campaign speeches referenced this opportunity. Press conferences celebrated the diplomatic breakthrough. So what happens when Exxon walks away and Chevron walks away and no private capital materializes, despite all the optimistic projections and political pressure? What happens when the Venezuelan government that we publicly supported starts failing because the promised investment never arrived and their economy collapses further into chaos? That's when this becomes our problem as taxpayers. That's when we hear about strategic national interest requiring government intervention to prevent geopolitical embarrassment. That's when public funds get deployed to prevent the collapse of a policy that was publicly celebrated, turning the $183 billion investment into the largest energy sector loss in American history, not funded by corporations who can absorb the hit through diversified portfolios, but by American taxpayers who were promised cheaper gas and got stuck with the bill for a failed investment instead. The trap is mathematical, not political. The timeline is set regardless of who's in office. The only question remaining is whether we recognize what's happening before we're too committed to escape without massive financial and political consequences. Because once government money starts flowing to cover the gap left by corporate refusal, once taxpayer dollars go into Venezuelan infrastructure rebuilding that doesn't generate returns, once political reputation gets tied to making this work, regardless of economics backing out, becomes politically impossible even as the losses mount quarter after quarter. You now understand what the oil executives understood months ago when they started quietly walking away from this opportunity despite political pressure to participate. You see the same calculations that made Professor Daigle say there's no compelling business case for any American company. You recognize why ConocoPhillips said it was premature to speculate while they have already decided internally that the answer is absolutely no. The $183 billion Venezuela oil trap isn't a future possibility to watch out for, or a risk that might materialize if things go wrong. It's a present reality that's already been set in motion by political announcements and diplomatic commitments. The math doesn't work at any price point. The companies know it and are walking away. The experts acknowledge it in carefully worded statements. The only question is whether we as citizens recognize it before our tax dollars get committed to funding a financial disaster disguised as an energy opportunity and a geopolitical victory. This is what it looks like when political promises collide with economic reality and mathematics trump rhetoric. And right now, reality is winning while we're being told to celebrate the opportunity.